What's up everybody? In today's video, we're going to be going over the 6th company on my watch list. These are all companies that I have thoroughly investigated and determined to be great companies that I'd eventually like to own. The only problem is that they are too pricey for my liking at the moment. So what I do is I place them on a watch list and patiently wait for a better opportunity to buy them at a more reasonable price. Because there are 8 of them and the full video is going to be longer than most of you would like, I broke them up into shorter videos on each stock. You'll be able to find all the individual videos by following the link to the playlist right up here. You can also click on the thumbnails at the end of each video and it will take you to the next stock on my watch list. So without further ado, let's get started. Next on my watch list is Autozone, ticker AZO. Autozone, along with O'Reilly, dominate the retail auto parts market. Not only do they operate those retail stores that service the general public, 30% of their sales are to other businesses. The good news is that both the retail and business-to-business segments are sticky, given that the average age of U.S. vehicles has been consistently climbing over the past 15 years. In fact, the average age of U.S. vehicles hit a record 12.5 years in 2023 and is expected to remain over 10 years for the foreseeable future. In other words, the demand for aftermarket parts and accessories is expected to continue to be strong. Additionally, demand for auto parts tends to be more protected from macroeconomic conditions than other industries, which contributes to the stability of their revenues, earnings, and cash flow that we'll take a look at later. They carry a wide moat based on a cost advantage as well as brand strength. Their brand strength comes from their superior customer service and massive catalog of parts. And this massive catalog of parts is made possible by their hub and spoke distribution model and automated inventory control system, which reduces the cost of distributing their inventory and also feeds back into the elite customer service. That's the first part of their cost advantage. The second is their extremely good relationships with their suppliers. So good that they've negotiated account payable terms that every retail outlet dreams of. They are given so long to pay their bill for their inventory that they are able to nearly sell that inventory before the bill is due. This is called a negative cash conversion cycle and allows Autozone to generate the huge returns on capital that they do. Revenues, net income, and cash flow are growing consistently in the 7 to 10% range, with the exception of declining cash flows over the past 4 years, which is being driven by higher capital expenditures and maintaining inventory levels. It's a bit concerning, but nothing to be alarmed about yet. It will be if cash flow continues this trend. On the other hand, earnings per share has grown at a much more robust 15 to 20%. And this is because they direct all their earnings and then some to buying back shares. In fact, this is one of the risks with this company. They're consistently taking on debt to buy back enormous amounts of shares, so much so that their equity is negative. That's right, their equity is negative. This earnings per share growth is a huge contributor to their 500% return over the past 10 years. So I'm just a little bit hesitant when I see their cash flow declining and the increasing debt loads to buy back shares in order to pump up the earnings per share. It feels like they're running this company like a casino. Profitability is outstanding. With a baseline return on invested capital of 40%, they're generating immense amounts of value above and beyond their cost of capital, and margins are strong and increasing. And what's so tempting is that they look like they're trading at a very fair price given the quality of the company. Their 19 forward PE is right around the S&P 500's long-term average PE. They trade at 3 times sales and they offer a 3.4% free cash flow yield. But Morningstar and CFRA seem to think that they're a bit overvalued. Morningstar estimates their fair value at $2,550, while CFRA values them at $2,700, and I have them at $2,917, but with a 30% margin of safety, I'd only be willing to pay $2,042. Well, that'll do it. I'd love to hear your thoughts on Autozone in the comments. Are you a buyer or a seller? If there are any other companies that you'd like me to take a look at, feel free to leave them in the comments as well, and I'd eventually get around to them. Also, please make sure you like this video and subscribe to my channel so you don't miss any videos when I release them. It's a quick and free way you can help me grow this channel if you find this content valuable. Lastly, to continue to the next great company on my watch list, click one of the thumbnails that you see on your screen right now. Until next time, you all take care. I'll see you in the next one.